Sasfin Securities. Earth is running a fever. The global average temperatures could rise by 4 degrees centigrade by the end of the century. A 4 degree centigrade elevation in average temperature would cause sea levels to rise, placing a massive strain on global water resources. Its effects will alter coastlines, facilitate ocean acidification, shift ocean currents, and change sea surface temperatures. The 2015 United Nations Climate Summit in Paris is where governments will seek to forge an agreement to prevent dangerous climate change, defined as global warming of more than 2 degrees centigrade. In the direct regulation firing line is fossil fuel usage, especially coal-fired power generation. There is likely to be new and greater incentives for renewable energy sources, and major developments in water access will be required globally. Technology advancements are creating concentrations and dependencies. There are two overarching technology trends: the growing technological concentration on electrical power and concentration of information technology on the Internet. There is a surge in renewable energy technologies from electrical power generation to storage. Massive growth in global Internet usage is being driven by expanding applications and a major shift in the mix of hardware from personal computers towards mobile devices. The information processing power of these new products, together with the increasing speed and access to the Internet, is giving rise to an expanding market for mobile and cloud computing. The Internet of Things, and specifically increased automation in industrial systems and processes, coupled with big data, will bring tremendous advances in information technology usage. Public debt overhangs. Since the global financial crisis of 2008-2009, public debt in advanced economies has increased substantially. Credibility and credit ratings are crucial as sovereign debt is unsecured and there is no international bankruptcy court which can enforce debt contracts. The IMF World Economic Outlook shows that gross general government debt had risen in advanced economies from 71% of GDP in 2000 to 75% in 2007 and 104% in 2011, and is forecast to rise further to 108% of GDP in 2014. Advanced economy public debt levels are unlikely to start declining before 2016, so their bond yields will need to remain around current, very low levels in order not to aggravate the budget reduction problems in the medium term. Feeding the dragon. Relatively sluggish manufacturing and service growth, along with a cash crunch and the intended policy reform, have cast doubt on the sustainability of China's plus 7.5% economic growth rate. Chinese authorities have been trying to discourage excessive lending by curbing official credit lines and slowing government spending. The two spikes in Chinese money market rates in 2013 suggest that the Chinese economy is dangerously overloaded with credit and state banks are increasingly struggling to meet regulatory requirements. Total headline government debt is a modest 53% GDP, dominated by local government debt. Local authorities have increasingly relied on bank borrowings and land development to fund their expenditures. Chinese banks and other Chinese investors are heavily invested in short-duration loans to beleaguered local governments. The level of off-balance sheet loans now exceeds that of newly issued balance sheet loans, many of which have been extended to highly leveraged real estate developers and local government financing vehicles. Constrained credit could be one of the key reasons behind the slowdown in China's GDP growth in 2014. Low interest rate trap. Low interest rates induce too much risk-taking and thus increase the probability of crises. Crises, in turn, require low interest rates to prop up the financial system. In a weakened financial system, raising rates becomes extremely difficult, so central banks remain stuck in a low interest rate equilibrium, which in turn induces excessive risk-taking. As short-term interest rates are compressed towards zero, large corporate borrowers can more cost-effectively raise money by selling short-term commercial paper directly to other corporations, pension funds, and money market mutual funds. Smaller banks find it increasingly difficult to borrow funds from other banks when interest rates are near zero. Other banks are not inclined to lend their excess reserves for a thin yield, even if the counterparty risk is moderate. The longer the Fed holds down its short-term interest rates without a material improvement in the economy, the more forward guidance is needed to anchor forward rate expectations. The Fed's intention to, and recent start of tapering the rate of its asset purchases has resulted in a steepening US yield curve. The Fed needs to strike a delicate balance to ensure the benchmark 10-year Treasury yield does not rise faster than real economic growth to sustain the recovery. Growth model in advanced economies under question. Until 2008, advanced economies used a combination of external savings and productivity improvements to drive their economic growth. Advanced economy policymakers now have to confront the two factors which have largely defined the economic dynamics in the last decade: globalization and technological change. Companies have responded by cutting their costs through reduced employment and lower wages. Investors are now questioning whether advanced economies are running out of investment opportunities, and more deeply rooted structural factors are limiting the longer-term growth outlook. In the US, job growth is recovering slowly, but the labor participation rate is falling to a rate not seen in 3 decades. A disproportionate share of the jobs now being created are low-paying jobs, such that the median US household income adjusted for inflation in the US is currently lower than it was in 1989. The current style of capitalism is not working. There is a rising level of income inequality, which is reducing economic and social mobility. The social and political ramifications must inevitably bear more seriously on these economies, where growing social discontent steers political debate towards a greater social emphasis. Vulnerability of emerging markets. Investors are now less certain about the sustainability of high economic growth in emerging market economies than they were 2 years ago. The new sense of vulnerability in these emerging markets lies in their dependence on China, foreign capital inflows, commodity exports, and high consumption rates, fueled by credit growth, all of which have occurred in the context of minimal structural reform during the boom years. The Fed's declared intention to start reducing its asset purchases began the reversal of the capital flows seeking higher yields in emerging markets. The capital outflows caused major currency depreciation, forcing a sharp tightening of monetary policy in many cases. The most vulnerable emerging market economies are those with large twin deficits and high external dependencies, and have been termed the Fragile Five, namely Indonesia, India, Brazil, Turkey, and South Africa. The vulnerabilities stemming from loose monetary, credit, and fiscal policies in the context of high dependence on foreign savings have altered their growth outlook. Increasing incidence of lifestyle diseases. Many advanced and emerging market economies are increasingly managing to control communicable, infectious and contagious diseases like malaria, HIV/AIDS, cholera, hepatitis, polio and flu. Unfortunately, non-communicable diseases, NCDs, are on the rise. NCDs have now overtaken infectious diseases as the leading cause of death worldwide, with nearly 80% of these deaths occurring in low and middle-income countries, according to the World Health Organization, WHO. As the globe's girth grows, so do the costs to combat the challenge. There are a number of key implications associated with the rising incidence of NCDs. Government healthcare budgets are on the rise. If the rising incidence of NCDs is not curbed in emerging markets such as South Africa, there will be a double burden of disease. Individuals' medical costs are rising. Here, medical and insurance incentive schemes can make a difference. Pharmaceutical companies, especially those focused on generics, are likely to be major benefactors of the rising trend in non-communicable diseases. Price regulation in the pharmaceutical industry is likely to broaden. There is a growing resistance to sweetened soft drinks, mostly in developed economies. The convenience food providers are likely to be forced to provide increasingly healthier food offerings. These offerings will differentiate them. Packaging companies are benefactors of this trend. Commodity cycle downswing still underway. USD commodity indices have been falling for the past 2 years. Passive commodity assets under management are down some 28% since the Libyan civil war 2 years ago. Many investment banks are either reducing or closing their commodity trading businesses. The relative performance of the S&P 500 has massively outperformed commodity indices in 2013. The decade from 2002 onwards was largely characterized by a rotation from developed countries to emerging markets and a supercycle in commodity prices. This rotation may be reversing, and importantly, the US is fundamentally more self-sufficient in commodity supply than China, and its investment to GDP rates are significantly lower. Global commodity supplies in base metal, energy and carbon steel inputs continue to come on stream at a rate faster than the slow recovery in global demand. The commodity cycle looks unlikely to start its upswing in 2014. This outlook dictates that company-unique factors must drive commodity company selection rather than a generic call on the commodity cycle. Africa rising. Africa has emerged as one of the fastest-growing regions of the world over the past decade. Research from McKinsey Global Institute estimated that resources account for only about 1/3 of the continent's newfound growth. The other 2/3 has come from internal structural changes in wholesale, retail, transportation, communication, and manufacturing. Many African governments have progressively adopted policies to energize markets. Although the policies of many governments have a long way to go, the important first steps enabled a private business sector to emerge. The underlying problem is the weakness of these economies' structural transformation. The issue of sustainability arises from the fact that the higher economic output rates have not translated into significant job growth. African political leaders may have to manage expectations downward while working to increase the rate of structural transformation and social inclusion. These conditions elevate the risk of social protest and political instability. Robust economic growth, the spread of democracy, and more inward foreign direct investment will create the space for greater structural transformation of African economies. If these factors come together, they portend more sustainable growth and development over the next decade. Domestic macro themes. Not business as usual. South Africa has a national election in May or June 2014. No official date has been set yet. In the run-up to the election, investors are likely to see and hear increasingly popularist chants. The reason is not difficult to understand. Unemployment remains stuck above 25% of the workforce in the context of an extremely low employment participation rate around 55%. The material shift in demographics in South Africa is making people more and more dependent on employment in an urban environment where self-sufficient subsistence is difficult. Popularism is growing in South African politics because of the unfulfilled promises made by the existing government in previous elections. There is growing awareness of the corruption, the abuse of official rights, little apparent accountability, and misuse of public funds. The key issues driving debate in the run-up to the national elections will be leadership, corruption, and employment. New political parties are forming to the left of the ruling party and have a strongly popularist stance. The risk lies in the ruling party shifting toward a more popularist stance to appease many of its discontented voters and the unemployed youth. The social engineering policies designed to redress the injustices of the past are likely to be accelerated and enforced more stridently, to increase the rate of the shift towards a racially proportional distribution of wealth, ownership and income in the South African economy. The mood in the country is changing in South Africa ahead of the next national election, which suggests that 2014 will not be business as usual. Consumer under pressure. Total South African retail sales growth slowed progressively through 2013 to a 1.6% rate year-on-year for the 3 months to October 2013. The household consumption slowdown has taken place in the context of loose monetary policy, where short-term interest rates have been at over 40-year lows for the past 2 years, and significant fiscal accommodation remains in place as evidenced by the sustained high budget deficit. Real growth in household remuneration has slowed over the past 3 years but remained above 2.7% year-on-year in H2 2013. Labour disruptions have eroded lower incomes. The household debt to disposable income ratio bottomed at a high 75% and is on the rise again. Household credit growth has slowed due mainly to a sharp slowdown in unsecured lending, mostly personal loans and installment sales, which is predominantly for passenger vehicles. High debt levels and rising credit loss ratios have forced tighter lending standards, not a tighter monetary policy. The higher income groups look likely to fare much better in the current environment than the lower income groups, both from an inflation, income and credit perspective. Within retail sales, the apparel and hardware categories are the most robust, with a sharp slowdown evident in durable goods. Rand vulnerability. The South African Rand, ZAR, depreciated materially during 2013. The nominal trade-weighted Rand, TWR, weakened 19.5% in 2013. The greatest ZAR depreciation was 28.9% against the Euro during 2013, 26.1% against the British Pound, and 23.4% against the US dollar in 2013. The ZAR has continued to weaken so far in 2014. Despite a low and declining gross capital formation to GDP ratio of 19.5% in Q3 2013, South Africa still had an exceptionally wide investment savings shortfall, 7.2% of GDP, which required foreign savings equivalent to keep the ZAR stable. This high domestic dependence on foreign savings is expected to persist in 2014, though some respite is expected in the current account deficit during 2014 as import growth slows in response to a weaker ZAR and mining production begins to recover due to fewer labour disruptions. The ZAR hedge factor will still prevail in 2014, but the rate of depreciation is expected to slow materially. The improved trade account should boost GDP slightly, but the ZAR remains highly vulnerable to changes in foreign investor sentiment in the lead-up to the national election and the Fed's progressive tapering of its asset purchase program. Investment ideas. Citigroup Inc. Citigroup Inc. or Citi is an American multinational financial services corporation headquartered in Manhattan, New York City. Citigroup was formed from one of the world's largest mergers in history by combining the banking giant Citicorp and financial conglomerate Travelers Group in October 1998. The year 2012 marked Citi's 200th anniversary. It is currently the third largest bank holding company in the United States by assets. Its largest shareholders include funds from the Middle East and Singapore. Citigroup has the world's largest financial services network, spanning 140 countries with approximately 16,000 offices worldwide. It also holds over 200 million customer accounts in more than 140 countries. It is one of the primary dealers in U.S. Treasury securities. According to Forbes, at its height, Citigroup used to be the largest company and bank in the world by total assets, with 357,000 employees until the global financial crisis of 2008. Ford. The Ford Motor Company is an American multinational automaker headquartered in Dearborn, Michigan, a suburb of Detroit. It was founded by Henry Ford and incorporated on June 16, 1903. The company sells automobiles and commercial vehicles under the Ford brand and most luxury cars under the Lincoln brand. In the past, it has also produced tractors and automotive components. Ford owns small stakes in Mazda of Japan and Aston Martin of the United Kingdom. It is listed on the New York Stock Exchange and is controlled by the Ford family, although they have a minority ownership. It is described by Forbes as the most important industrial company in the history of the United States. Ford introduced methods for large-scale manufacturing of cars and large-scale management of an industrial workforce using elaborately engineered manufacturing sequences typified by moving assembly lines. By 1914, these methods were known around the world as Fordism. Ford's former UK subsidiaries, Jaguar and Land Rover, acquired in 1989 and 2000 respectively, were sold to Tata Motors in March 2008. Ford owned the Swedish automaker Volvo from 1999 to 2010. In 2011, Ford discontinued the Mercury brand, under which it had marketed entry-level luxury cars in the United States, Canada, Mexico, and the Middle East since 1938. Ford is the second largest US-based automaker and the fifth largest in the world based on 2010 vehicle sales. At the end of 2010, Ford was the fifth largest automaker in Europe. Ford is the 8th ranked overall American-based company in the 2010 Fortune 500 list, based on global revenues in 2009 of $118.3 billion US. In 2008, Ford produced 5.532 million automobiles and employed about 213,000 employees at around 90 plants and facilities worldwide.